Good morning. Here we are. It's Friday and bracing for a sell-off across these markets. 30 minutes to the open in Hong Kong, Shanghai, and Shenzhen. You're watching The China Show. I'm David Ingles with Annabelle Droulers.
Our top stories: Asian stocks extending a fresh market sell-off on worsening trade tensions between Washington and Beijing. Traders turning the most bearish on the dollar in 5 years.
Now, the White House says tariffs on China are now, get this, 145%. The president acknowledging what he calls transition problems, but expressing confidence in his plan.
And we speak exclusively with the Philippine central bank governor after the BSP cut rates and signals more policy easing ahead on rising trade risks. All right, Dave, you said we're bracing for the sell-off, and we certainly are in Chinese equities this morning. But actually, for Asia across the board, we are already here. You've got the broader gauge down more than 2% right now. The selling brunt really being felt in the Nikkei as well. I think you've seen at least 5% fluctuations each day of this week. So you're off again this morning. But really what's driving it, of course, is these ratcheting trade tensions between the US and China. And we saw more of that overnight as well, this tit for tat and different things that are being applied. For instance, even films from Hollywood now perhaps less likely to be sold in China. So lots of different ways that it can be felt. This is the state of play here as we see again that big move back into haven. So you've seen traders moving into things like gold, for instance. We've seen the yen being bid. Treasuries, of course, one to track again. Huge moves in yields across the course of this week. Dollar under pressure so far in the session, down 0.5%. But let's take a look, because traders are very nervous right now, and you see that being expressed in a lot of different ways. So taking a look at the Golden Dragon Index, for instance, overnight, off 1%, but also what led into the selling pressure was a report out at Fox News, actually, saying that perhaps President Trump could be looking at possibly delisting some Chinese firms that have their ADRs there. Alibaba, for instance, one of those to watch. Again, so you did see that under pressure. How we're setting up for futures today, going to be watching things like the Yuan fix very closely in just under 15 minutes from now. Of course, those big moves that we're continuing to see in Chinese government debt. We're retreating here on yields this morning. Again, futures under pressure. One thing to note as well, something that's been pretty well read on the terminal this morning is a call out from SMBC Nikko, essentially saying that perhaps China could also be looking at further selling their treasury holdings.
Yeah, that's really one narrative that's really emerged this week, given the melt-up we've seen in yields. And I think the point you're making there, Bell, when you look at the 30-year Treasury, as you were just pointing out there, this steepening in the curve, this melt-up that we're seeing there. So I just had to look at the data, in fact, when that note came out. So we've come from Chinese holdings of U.S. Treasuries. We've come from about 1.2 trillion. And this was all the way back in 2017. So that's now come down substantially, about, let's call it $500 billion US of drawdown from 2017 up until the latest data point, which was as of January this year. So 440 billion. They have been reducing their treasuries. Now, the question is, have they been selling, right? And I think we put that question yesterday to one of our guests, active bond manager, and they said there's very little indication that they're doing that right now. But I guess on that note as well, there is someone selling treasuries. It doesn't need to be China selling treasuries. You know, this liquidation and rush into cash is perhaps one thing that's worth pointing out. Here we go. Thank you so much for our producers for rushing this chart out. There we go. $500 billion lighter as far as the holdings are concerned. This goes into the market story today, where you have a massively softer dollar. The Bloomberg Dollar Index is seeing 3 days of, I think, 2-3% drop there. This is the fear and greed indicator, which effectively measures the ratio of selling pressure in equity markets to buying pressure. And we're seeing that ratio now, the most negative, going back to the onset of the global pandemic, when, frankly, no one knew what was going on and what was new was ahead. And there's really just amount of volatility in this market. So that's number one. And when you look at the risk reversal, say, on the US dollar, I know I'm inundating you guys with a lot of data right now, but it's important to note the magnitude and the second-order derivatives we're seeing in this market, with risk reversals on the Bloomberg Dollar Index now, in fact, now also indicating the most bearish positioning in the markets across the dollar space going back about 5 years. So all of this will go into today. So the story in China is, do we get more market support? Number one, do we get more turnover? 1.5 trillion daily turnover so far onshore. We are in the window for some data, which I guess we can set aside for now. We are on watch, though, for rate cuts or a form of easing coming out of the PBOC, whether that's in the form of, again, a weaker fix for a 7th day. You look at what swaps are telling you. Swaps are now falling below the repo rate. So there is speculation in the market, and state media have signaled this as much yesterday, that it is appropriate right now for China to lower interest rates.
Yeah, that's actually was the front page commentary on the Securities Daily, and essentially saying, yes, it's the appropriate time for China to look at cutting interest rates and also perhaps triple R, as you say. But certainly you also have seen that expectation of further easing that's being felt in equity markets as well. But, I mean, easing is something that other central banks are doing as well, including the Philippines.
Yeah, yesterday, 25 basis points. They've signaled for more. In fact, let's bring in the governor himself out of the BSP, Bangko Sentral ng Pilipinas. Eli Remolona joins us right now to talk us through, of course, their course of action, their thinking, and what perhaps lies ahead. Governor, thank you so much for joining us this Friday. Good morning to you. Before
morning,
we
David.
jump into
morning, Annabelle.
interest rates specifically, I want to ask you, the market gyrations we've seen this week, do I again take it that the BSP has been active in the currency markets this week?
We haven't been intervening more than usual this week. As you know, the dollar has weakened. We're not too concerned about the exchange rate right now. We're more concerned about the risks to growth, and we're more concerned about prospective inflation. But we actually see lower inflation in the Philippines, as well as lower growth.
All right. So I think the last time we spoke, Governor, which was not too long ago, I think it was just 2 weeks ago, you mentioned that we might get 3 cuts this year coming out of the Bangko Sentral. You had one yesterday, of course, and it now leaves 2 more this year. Do you think you'll be able to move more than 2 times this year?
Yes, I think so. I think our forward guidance says that we've become somewhat more dovish now than a week ago. So yes, a few more cuts.
Can you quantify then how much easing are you expecting in 2025?
Well, I think we have 4 more meetings left. We don't think we will cut between meetings. So we're not sure how many more cuts, but I would say a few more this year.
Okay, and
it depends on depends on the data.
Right, and if the data does fall in line or come in softer, I mean, you mentioned 4 meetings, would it be a stretch of the imagination for the BSP to cut at every meeting this year?
I would say so. That would be maybe too much easing, but we'll see. We'll see. As long as we don't see a hard landing, I think we won't cut at every meeting.
Okay. Governor, what's your projection right now of the neutral rate of the BSP?
It's I can't tell you the exact number because we have 3 estimates. We usually go with the middle estimate, but I would say around 2%, but that's not a precise number. 2% in real terms. So in terms of the policy rate, you have to add to that expected inflation.
So is it conceivable then that we see the key rate heading below the neutral one?
It's more like the policy rate heading down towards what we call the Goldilocks rate. And at the moment, we're somewhat above it. We're somewhat restrictive still, and we're moving towards a neutral stance.
Governor, one of the things that you mentioned right after the meeting, and I saw the headline, that while there are a few cuts on the table likely this year, you do see the end to the easing cycle this year. What gives you that confidence that you'll be able to bookend your easing cycle in 2025?
Well, we don't want to overdo it. If we overdo it and then we start to exceed capacity, then inflation comes back. So we want to get to the neutral rate smoothly. We don't want to go too much below it, because that would be inflationary. So we're looking at the numbers just to make sure we don't overdo the easing.
It's obviously a very difficult time to be a central banker, particularly given all of the tariff news this week. And even though we have that reprieve, we've seen very big gyrations in the treasuries market in particular. How are you managing that? And also, are you looking at changing your holdings of long-term government debt in the US?
We're not looking at reducing our reserves. We will diversify our reserves, and for now, I think we have just the right mix of assets in our reserves. So no, we're not looking to reduce our holdings of U.S. Treasuries.
Governor, this week has really been one of those weeks where it's plausible that policymakers are, contacting and communicating with each other, given just the dislocations we're seeing in some parts of the global financial markets. Yes. Are you in touch with some of your peers across the region?
Of course, yes. We're comparing notes. We're exchanging text messages. Yes.
Oh, well, take us into that WhatsApp group, Governor. What are you guys talking about?
I'm not using WhatsApp. I'm using just a regular phone message. Maybe I should organize a WhatsApp group among the governors, among my favorite governors.
Oh yeah, but Governor, just to make sure, you don't inadvertently include a journalist in there as a joke right now. Governor, can you tell us more? Like who are you in touch with in terms of central bank governors?
Let me say a few in the region. Close by in our own time zone, and then a couple in other time zones.
What's the concern that you're hearing? Because of course we know the Philippines, it's more of a domestically faced economy. It's a little bit more insulated from these tariff risks, particularly when you compare to your peers. What's sort of the message or the key issues that are in this, if not a WhatsApp, but the message thread?
Yeah, as you said, we're less subject to the uncertainty. We're less subject to the tariffs, but our neighbors are. They're more subject to it, and what happens to our neighbors affects us. So in general, we're looking at lower growth because of the uncertainty, because of the volatility in the markets, as well as the prospective tariffs. We know our neighbors are subject even more than us to those factors, but we're all looking at slower growth. Unlike our neighbors, we're looking at lower inflation as well, partly because of the factors you mentioned. We don't trade as much as our neighbors. Our markets are smaller than our neighbors. So the impact of us is...
How much are you and your neighbours concerned about China and the way that it could also retaliate to these tariffs? For instance, Yuan devaluation could be one way. There's the concern that we could see China looking to new markets to send overcapacity, essentially. What's your reaction to how China's going to be managing this?
In general, shrinking trade is bad. It's bad for everyone. It's bad for us. China is the #1 source of our imports, and some of the things we export are part of a value chain that involves China. So what happens to China affects us. We don't know exactly how at this point, but we know there will be some effect. In general, we see trade shrinking, and shrinking trade adds to inflation. It's reducing supply, so that would be somewhat inflationary, as well as a negative for growth.
Governor, there's been a substantial drop in oil prices, global oil prices this week, and I think the last time we spoke, you had mentioned that some of the upside risks to the inflation basket in the Philippines, things like energy, for example, rice,
yes,
I think
yes,
was
yes,
one of the things
yes.
that you brought up as well.
Yes.
I mean, certainly the calculations there have changed substantially in the last, let's call it 2 or 3 weeks. Would you say there are downside risks to inflation? And are you happy right now with the BSP's inflation targets? Are you reviewing that currently?
Oil has been a big factor in our in the decline in our forecast for inflation. Oil as well as growth, because slower growth also leads to a decline in our inflation. What was the other question, David?
What was that? Sorry, Governor?
You had a second question that I missed.
Oh no, yeah. On your inflation targets, or your projections currently, I know the central bank had put out several figures along with the statement yesterday,
yes.
and I'm wondering whether you're currently reviewing those projections and whether you think there's downside risk to those projections.
We are constantly reviewing our projections. We're also reviewing our target for inflation. We're not sure whether it's the right level. Right now, we're looking. Our target is a range between 2 and 4%. That may be a bit high, so we'll see. We're doing the math for that, and we will know maybe next year.
Oh, okay, Governor. Sorry, I need to ask you a follow-up then, because that 2 to 4% target has been there, as far as I can recall.
Yes.
What's giving you reason to rethink that? Let's call it inflation paradigm.
Well, the reason the target is higher than for most other central banks. Most other central banks have a 2% target. We essentially have a midpoint or the target range of 3%. We need some inflation because of the adjustment in relative prices in countries that are growing. But we don't know whether we need that much of a scope for relative prices. So maybe 3% is a bit high. Maybe 2.5% is a better target. But that's for next year.
Eli Remolona there. Thank you so much for joining us this morning in an exclusive interview after, of course, cutting the key rate yesterday. That was the Philippine Central Bank governor there. And just as we've been discussing, the Yuan reference rate has come out at 720.87, so another day above 720. Lots of questions around what sort of depreciation we like to see. Some are saying it could be orderly, but as well, Danske Bank and Bloomberg's top Yuan forecaster last quarter seeing maybe a 5% chance or 5% devaluation or depreciation from here. Counting down to the open of trade in Shanghai, Shenzhen, Hong Kong. You're watching The China Show, and this is Bloomberg.
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond nobody. How people stood for it, sitting in my position, is not even believable.
President Trump there reiterating that he does want a trade deal with China. Let's bring in our team here. Our China correspondent, Min Min Lo, joins us along with our MLive's Garfield Reynolds, of course, who oversees our blog there as well. Min Min, let me start with you. The likelihood now, given the comments or latest comments, I have to caveat that because there's always the latest comment seemingly here, the likelihood of a deal with China, and what's the reaction been so far to those comments?
Yeah, so you heard that soundbite from President Trump saying he would love a deal, but he's previously said he's waiting for that phone call from Beijing. And meanwhile, you have the Commerce Ministry yesterday saying they are ready to have dialogue with the U.S. as an equal partner. But if the U.S. is not ready for that, then China will continue to fight till the end. So both sides are waiting for the other party to extend that olive branch to create the opening for dialogue. And I'm just not sure when that is going to happen. But for now, though, China has retaliated by restricting the number of U.S. films coming into China this year, which is a very interesting move. Number one, it's a high-profile move with very little downside for China. But Some analysts, though, say because the wording here from the Chinese Commerce Ministry is that it's not going to be an outright ban, it's a moderate reduction. So some analysts say maybe China will still import the big blockbuster films because that would still whet the appetite of Chinese consumers, something China really needs to do now, and they might limit the imports of the smaller film. And of course, this is a signal that China may be now shifting gears to expand this economic war beyond tariffs to other sectors, including services, because this is where US has a trade surplus with China. It's in the services sector, including things like transportation, IP royalties, and travel. And of course, there's also a lot of speculation about how this could expand to the financial sectors as well, because so far we have seen how sometimes China announces its retaliation just ahead of US futures trading. There's speculation now that Trump could consider delisting Chinese companies from US stock exchanges. And it's possible if China assesses that further tariffs is just not going to make further marginal impact, they will just expand this to even to other areas of the economy.
Yeah, one of the criticisms or analyses of how Trump has handled this is that he's given Xi sort of a green light to increase economic ties with other parts of the world, and we're already seeing that perhaps with the EU. Yes,
already this week there had been a couple of calls being made. So the Chinese Premier Li Qiang having a call with Ursula von der Leyen, and then the trade representatives from both sides speaking on video call as well. An interesting readout from the Chinese Commerce Ministry saying that both sides have agreed to start immediate negotiations on price commitments on EVs. So that's an interesting development. Could it be a hint of potentially the EU eventually lowering tariffs on Chinese EVs? We also have the SEMP reporting that China plans to host some of these EU leaders in July. And don't forget, there is the Spanish Prime Minister visiting Beijing today after a visit to Vietnam, again, in defiance of the US warning that a tilt from the EU to China is equivalent to cutting their own throats.
Garfield, let me bring you in. The equity market's down, gold is higher, and it looks like treasuries and the US dollar are really on offer right now. Does this continue into the weekend, into next week, Garfield?
Well, it's hard to see why it wouldn't, unless there's another change from President Trump. And I think if you're looking at the potential for China, for example, to blink, as it were, well, they've just seen Donald Trump blink about the rest of the tariffs when US Treasuries sold off heavily and 10-year and 30-year yields jumped. So they might be thinking, well, we can now see it's not as heavy, but we can see the same sort of thing happening. Stocks are falling, treasuries are falling, the US dollar is falling. If this goes on, might not Mr. Trump decide that he needs to pause something else? And the only thing he has left to pause out there is some of the China measures. So that might feed into their calculations. In the meantime, there is a clear theme developing for investors that they're getting warier and warier about US assets. And I think yesterday's decline for US stocks in particular has to be very concerning on that front, in that we had the huge rally the previous day after Trump first of all tweeted, great time to buy, and then announced the pause. So that rebound, you would hope that that would effectively mark the bottom for the current route. Instead, it looks like at least some investors decided, well, this gives us a better exit point. Thank you very much for bringing prices back up, especially if we put a little bit of money in at the previous bottom. But now we look at it, doesn't look like a particularly stable outlook going forward. We might as well take more money off the table because you've just created for us some better prices to sell at.
Okay, well, happy Friday to you too, Garfield. And Min there, Min Lo and Garfield Reynolds, they're really just outlining the instability across these markets and risk assets going into the Friday session. And the approach, as you can see, is one that is seeing equity markets on offer, and gold, of course, now at 3,200. The Open is next. This is the China Show.
Welcome back. You're watching The China Show and we're counting down to the open of markets this morning. It has been absolutely whipsaw trading across the course of this week. But today, it is negative across the board. China could stand out a little bit better, and you're seeing futures there for the mainland pointing with some upside, but maybe that's expectations of easing that are continuing to build in as well to markets.
Yeah, I think you're looking at the swaps rates are now below the repo rate, which is an indication of, I guess, rate expectations. The PBOC has been setting weaker and weaker fixes, except for today, though, where the fixing was actually more on sort of sideways, but still on the weaker side of things. But I think, you just simply read state media, and you are getting a very good indication there of where rates are probably going to head. It's also worth pointing out that we have been waiting for the triple R cut for, what is it? It's April now, so for the better part of the last 3-4 months. And that actually came from the PBOC governor himself late in December, who talked about, of course, that they are about to cut interest rates in December. But then again, after December and in between December and now, the priority became currency stability. But as we were pointing out, the 6 days of weaker fixes does indicate maybe a change in those priorities. We're down onshore. Just to mention, as we flip the page, we're looking at things like southbound flows, which turned negative yesterday. Turnover has been massive onshore this week. In fact, every day we've seen turnover north of, I think, 1.5 trillion renminbi. Okay, we were looking at declines at the open. That's exactly what we're getting. And in fact, we are seeing a slight acceleration there in selling, although this is really, if you compare this to what else we're seeing across the region, this is actually a very good price move, relatively speaking, there as well. Okay, corporate news doesn't matter today, really. Earnings doesn't matter. It's really all about this. But yeah, we're looking at tech and volatility here, Val.
Yeah, and it's sort of hard to think of something that could be more fearful to traders than the tariff risk right now. But our Bloomberg team has been looking into exactly what risk there could be for investors that's aside from that or in addition to that. But let's get more on that now, bringing our Asia equities reporter, Winnie Zhu. And thanks very much for joining us. So this is about tech shares in particular. And what's the risk that is in addition to tariffs right now?
Yeah, so right now, just kind of taking a step back, we saw how much tech shares has actually run this year on the optimism around DeepSeek, and that has really outperformed still the HSCEI. So without that catalyst there around DeepSeek, that's going to be the very first sector to get sold off. And now we've got even more risks around the delisting of the shares in the U.S. So those actually would hurt sentiment as well. And people right now, the worries are adding beyond just tariffs. So the non-tariff measures that might kick in, including the delisting we talked about, but also potential more sanctions and the restrictions around the tech. So these are some of the further worries that are adding on to that already very weak sentiment we're seeing around tech and the Chinese equities overall.
What are some bright spots?
Right. So when you look at the valuation, it's still on the cheaper side. Just when we talked about this entire big sell-off in the Chinese stocks, it's on sentiment, right? The weaker sentiment. So it's kind of indiscriminating at this point. So lots of internet companies that actually don't have much U.S. exposure at this point are also getting sold off. So when we talked to fund managers at Aberdeen the other day, they were saying that they're actually adding to some of the internet companies right now that are getting oversold without much of kind of the reasons while they still have really high qualities. So kind of picking those pockets are some of the areas that people are looking at. But at the same time, when you just look at the performance of Chinese equities, even just yesterday or today, yes, it's getting sold off, but compared to overall Asia, actually not as much, because people are still expecting more policies to come in at a bigger scale, at an earlier pace, just because China still have that 5% growth target that they need to hit. And with that bigger tariff that's going to impact the Chinese economy and potentially weakening the domestic demand over there, there's more urge for the government to step in to come out with higher policies that could potentially be positive for the tech sector and the broader Chinese equities.
Near term, what's the outlook for trading then?
Sure. So lots of volatility here, and it really depends on what China is going to say. Just like we mentioned earlier, the optimism there is still there to kind of drive the floor for the Chinese equities. So people are saying that maybe tariff risks somewhat has already been priced in for the Chinese stocks at this point. So we are waiting to hear for more details around if potentially stimulus is going to come out and if there is also more advancement around what's going on with DeepSeek. So that is what people are looking forward to. So hopefully at this point, Chinese stocks can still be preferred over some of the emerging markets that are getting hit even further on the tariff risks.
Winnie, fantastic. To set us up for Friday, Winnie Su there, our Asia equities reporter, now based out of Hong Kong. Very nice. Okay, we'll see more of you. Right, breaking news, CATL, this is that massive listing that we're expecting this year. In fact, it could be, if not likely, will be the biggest listing here in Hong Kong this year. Now it says it did get approval for that Hong Kong listing. We're looking at potentially at least $5 billion cash call here in the world's biggest stock offering this year. It's currently listed onshore, and it's currently making the jump, of course, to list their shares here in Hong Kong. It's hard to imagine that Hong Kong would not approve this. But anyway, that's just a side note. I mean, let's bring in Eva Lee, who's giving us a bit of a snicker this Friday, of course, something maybe to talk about. Head of Greater China Equities at UBS Global Wealth Management. Have the tariff risks been priced into Winnie's earlier point there?
Tariff risks, no.
What do we do now? Wait? Pass? What's the advice?
Defensive. I think stay defensive.
Stay invested?
Stay defensive. Like the dividend yield stocks that I actually have mentioned a few times, the energy, the financial, the utilities, the telcos. They are the ones that giving you, last night I looked at it, average of 6% dividend yield. You just show that the central government yield from China is 1.6.
Yeah.
So there is a positive carry. And plus, we know that the national team has been buying, well, not today, but on Wednesday it has been buying, very obvious. So what they're going to buy, obviously, are the dividend yield stocks mainly. So that will be supported. But overall, if you look at it now, Asia will do better than H, clearly. National team helping. H will be more international investors. They worry, so H will be under more pressure. And of course, tech, right? Tech, it's like 35-40% of MSCI China, the H share listed. So tech, technically a growth stock, right? Slower growth economy, not necessarily very positive for growth stock. More of a value stock now. Yeah.
When Dave asks about tariffs being fully priced in, I mean, tariffs at this level are almost going to have a negligible impact beyond the initial part, because you essentially are just totally cutting off trade between the US and China at this point. When you're talking about what's priced in, do you think an economic war is priced in right now?
In fact, let me sort of elaborate a little bit more. Like, I understand that, 125%, how can you say not priced in? But the situation is going to sort of expand to other spectrum, exactly what you said. So the conflict between the two countries is not just on trade now. Looks like it's going to spread to financial. There have been concerns about whether China is going to sell its holdings of Treasury of U.S. And on the other hand, U.S. talking about the American first investment policy, potentially pose any restrictions onto this VIE structure, which is what the tax stocks are. So these are all my concern. Like when I sort of lay out, all this market, some of the negatives that are, it's there, it will hit the market. Like any sanctions on individual companies, or maybe U.S. will be restrict certain companies selling particular things in U.S. Not just tariff, it's actual restrictions. So all these are still could be in the pipeline, and that could affect Chinese equities performance.
What are your clients thinking this week?
We have a few clients that actually have take profit ahead of April 2nd. I'm like, wow, well done.
Yeah. Well, is that because of your advice, or is that on their own?
Well, we highlight the risk, but actually not, particular, you're talking about some of the individual investors. They can make
what's the sense right now of wealthy individuals?
Worries, where to hide. Now I have some of these stocks that have downed. What should I do with it? Rotation. If I still have some cash, I worry about inflation. How should I position? That sort of things. Yeah.
And aside from staying defensive, I mean, what else are your other proposals?
We do see some stocks that showing potentials. Like, I know that China EV as a whole, people worry about, tariff. In fact, a lot of these Chinese EV, they do not export to US. Even under Biden restrictions because of the tariff war already in place. So they actually have been focusing on ASEAN and Europe market. And, the leading ones, actually, they just announced the first quarter results. Thus, they're showing sequential and year-on-year growth, very strong numbers. So they do have competitive cost advantage with or without tariffs. So these type of stocks that, if you sort of thinking about medium to longer term, that they can survive and do better even under the tariff, impact, these are the ones that people can start to pick it up. But, do your downside protections and all that, just in case of volatility.
Right. What we've seen also this week is we've seen economists, which is funny enough, well, as expected. So the last 2 months, they've bumped up their forecasts on Chinese growth. In the last 2 weeks, they've taken that back down almost immediately. And I'm wondering, do you think we'll get an earnings? We're entering earnings season in China and wondering whether or not we will see that in forward guidance or revisions lowering these earnings as we try and figure out what the proper valuation is right now.
Well, obviously, it will all depends on whether individual companies have exposure to the tariff.
Right.
The U.S. revenue exposure, which is only 2 or 3% of MSCI China. But I think the key things why the market have slowed down, it's the worry about sentiment. Right?
Okay.
So with this tariff, you would expect people would not invest more, people would not consume more. So these are all the things that makes everyone cautious about the guidance for the rest of the year. I mean, no doubt, right? And plus, the market tells you, we worry too. So back to your question, I think the earnings guidance would be very prudent. And they would be clear about how to control costs. Back to the COVID time, remember? That was like, I don't know how much revenue I can gain, but what I can do is improve my cost control, and so that I can get some leverage on operations if I can.
For the investors or clients that took their money out and now are sitting waiting to invest, which market would you recommend for this year, based on the fact that it sounds like you're really seeing that we're setting up for protracted decoupling here?
Doesn't need to be limited to China. US
or China, which market will outperform this year?
Well, I have to say, overnight we upgrade US equity to attractive. I know that everyone will jump to the fact that, hey, tariffs between US and China, why you keep China neutral and US attractive? Okay, technically, if you look at U.S., we are expecting a technical recession in second quarter and third quarter. We expect an interest rate cuts of 75 bips. It could be 100 bips for the rest of the year. So in such a scenario, when the market is facing a recession scenario, the market will be very sensitive to news flow and also at what level we are. We did see that on Thursday, how S&P could, sort of bounce up. So we consider, there are two things that we need to read from the development on Thursday. First, Trump do care about economy. So that's why he's sort of backed down with that, right? Yeah. And if that long tail risk being cut off, then you can see a bit more rational, situations of U.S. I think that's how, and plus, given the corrections that we have seen, 20+%, if you look back at the historical track record, after this sort of corrections, if you sort of think about what's the forward, likely you will have positive returns if you look at historical track record. So that is how we come up with this sort of attractive stance on U.S. equities.
That's a very interesting call.
I know. I know. Yeah.
But it was great to have you on this morning and great insights as well. That was Eva Lee, the head of Greater China Equities at UBS Global Wealth Management Chief Investment Office. And, of course, China's official media is continuing to step up their rhetoric against tariffs and projecting confidence in the nation's economy and markets as well. But taking a quick look at what is the front page commentary in the People's Daily that's titled, "Believe in China, believe in tomorrow. It's touting the country as a stabilising force for a world economy that's rocked by trade tensions. It says China remains a top destination for foreign investment, while accusing the US of unilateralism, protectionism and economic bullying. Another article as well blasting Trump's tariff policies, calling them a form of blackmail that's going to be disrupting global production and supply chains. It says protectionist measures violate economic principles and undermine the welfare of the global population, and that includes Americans.
Meanwhile, you have financial papers projecting, as I think Bell was underscoring the very point there, confidence this time in Chinese assets. You have Shanghai Securities News says capital markets have shown stability, cohesion, citing state funds, of course, purchases and government supports, to the point that Eva Lee was just making there, of course, midweek, and that put coming through there. You have institutional sources also telling the paper that short-term market fluctuations were due to emotional shocks, but that long-term sentiment will recover. Native Chinese officials have also been amplifying Beijing's message, including on Western social media. The Foreign Ministry spokeswoman Mao Ning posting this video of Mao Zedong with a caption, "We are Chinese, we are not afraid of provocations, we won't back down." In the clip, the late former leader was speaking just before China entered the Korean War, saying the nation will never yield and will fight until it completely achieves triumph. We'll leave you with that thoughts. Plenty more ahead. This is Bloomberg. Welcome back. You're watching The China Show. Let's hear now from Ray Dalio, Bridgewater Associates founder, of course, who talked about President Trump's tariff and trade policies. And he says it actually could have been handled better and have dramatically affected, he says, attitudes towards America's reliability. He spoke with Bloomberg about a likely U.S. recession and what needs to be done to fix Washington's relationship with Beijing.
There has to be a recognition that we have a structural problem in that we have an interdependency that the United States can't, either financially or geopolitically because of the risks, be in a position where it's dependent on getting stuff from China. And similarly, for the Chinese, they can't feel safe about getting their capital returns in that way. So in a global economy, you can't have, by definition, large imbalances. So now the question is how to deal with that. That's an engineering exercise. In my opinion, they can have a negotiated way in which the currency is raised. They have to, in one way or another, deal with this, reduce that. So the currency can be raised, the RMB, which would happen by then starting to sell off reserves. The United States likes the fact that the currency would appreciate and that probably the Chinese like the fact that they can get less in debt by selling off some of their holdings in that dynamic to support the currency, in which case then China has to not just be a manufacturer, but it has to be a consumer. And right now, about 33% of all manufacturing in the world, which is more than the United States, Germany, and Japan combined, is from China. So they manufacture. The United States does not manufacture that. And so what the world needs now is the Chinese to be consumers. So if you were to have that foreign exchange increase and you were to deal with trade together in a sensible way, I think, ideally, then you would also have, naturally, Chinese doing an increase in monetary and fiscal policies to raise demand, particularly consumption, because exports are going to go down. Manufacturing is going to be a problem, so that if they raise consumption and the United States becomes less consumption driven and more production driven, at least those are movements in the right direction. Such negotiations, unfortunately, and such actual big changes are unlikely to take place quickly enough and well enough, is my fear.
Mm-hmm. But, right, I mean, given that and given this possible permanent scarring of U.S. dollar and treasuries, is a U.S. recession actually avoidable?
I think it's likely that we're going to be in a recession. And the question really, recession is, a line at zero you get, and then, sort of 2 quarters in that. And I think right now it's close call and it's probable. But who cares about, let's say 2 quarters of stagnation or a little bit of negative? I'm more worried about the greater dynamic of these conflicts. I'm worried about more serious issues.
That was Bridgewater Associates founder Ray Dalio speaking with our colleague Francine Lacroix. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function TV Go. You can also join the conversation by sending us instant messages to us, to our guests, during our live programming as well. So check it out at TV Go. Plenty more ahead. This is Bloomberg.
Right, 25 minutes into the session, we're just going to breeze through some big movers here. Prada, of course, sweeping Versace off the floor. Now purchasing the company here, $1.4 billion. Change the page, Country Garden up, getting some support for restructuring. That's point number 2. Point number 3, change the page, please. Geely Auto out with some strong prelim numbers. Shares are up for a 4th straight day, 3.5%. So there are some bright spots amidst this. At least Greater China, we're looking at either sideways or slightly lower. Across the region, though, we're substantially lower. Plenty more ahead here on The China Show.
Welcome back to The China Show, taking a look at the Hang Seng half an hour into the session this morning. Look, we're lifting off the lows of the day, but the broader gauge is still in negative territory this morning. Hang Seng Tech doing a bit better. I did find it interesting what Eva Lee, though, said in the last hour from UBS, that divergence between A and H shares, expect that to widen.
In favor of A shares this time around.
Yeah.
Because that's where the state support is targeted, and that's, of course, where you get the big winners have been HS Tech, for example, right? So that's where you're going to get the brunt of the selling. Really salient point as you look for trading opportunities short term. UBS, by the way, to the other point that they were making, upgraded U.S. equities overnight in terms of just relative preference, let's put it that way. Right, as you look at gains, or at least bouncing off lows right now, it's worth mentioning that volumes are on the lighter side of things here on the Hang Seng Index. Elsewhere, though, and really the story across these markets is still, so we're down on the short end, we're still higher on the long end, but we are coming off highs on yields on the 30-year. We got extremely close to the 5% handle in the U.S. 30-year yield. We're coming off a little bit as well. In case you missed that, of course, U.S. CPI overnight did come in slightly softer than expectations. Major currency markets, that's the next thing to watch here, too. Dollar on offer substantially, as you can see. So we now have a 113 handle on the common currency. We have cable, not on your screens, at a 130 handle. Dollar yen was below 143 at one point. We have since paired, as you can see, a little bit. But the dollar is down one of the worst weeks so far in the last year and a half or so, and risk reversals are pointing to, change the page, please, the most bearish expectations around the U.S. dollar from traders. Okay, the fixing, this actually tracks the fix of the day. Rightmost side of your screens, you see that weaker and weaker fix for 6 days, and then we're flat on the Friday session, which perhaps is leading to some strength coming through in the Chinese currency. But that said, relatively speaking, Asia outside of China is still on weaker footing. And we're looking at the Nikkei selling off 5%. In that case, very heavy volumes on the Nikkei, 30% heavier than usual. And here's the rub. S&P futures are extending losses in the Asian session in the order of about 0.7%.
Yeah, it's really just that tariff uncertainty and the rising tensions between US and China, because you think about the VIX, for instance, overnight, we had sort of fallen down, but you're back above 40 now again at a very closely tracked level. But the White House as well saying its tariff rate on most Chinese goods is now at 145%. As we said, deepening that trade war between Washington and Beijing. Let's get more now with our senior editor, Bill Ferry, is joining us from Singapore. And Bill, we know President Trump is watching the bond market very closely, and that the rout in it also factored into his decision to put that pause in place, the 90-day pause on tariffs. Now that we've seen, again, the markets fluctuating overnight, do you think it's going to be shifting his thinking at all?
Well, at least publicly so far, we're not seeing any indication that he's concerned about it. Asked on Thursday in Washington about whether he'd been looking at the stock market reaction to it, he said he hadn't looked at all. Now, we know behind the scenes there may be something else going on, and we did see that big reversal earlier this week. But publicly, the president is saying there's going to be a transition, that it could be a painful transition, and that he's going forward. I think he wants to see how some of these potential deals start to come together with some of the trading partners that he's prioritizing so far. But there is a big question about what the president's pain point is and how much of these market declines he can really stomach.
Yeah, alongside that, Bill, markets are also trying to figure out who to listen to, right? So I think you have Peter Navarro, the key architect of the original tariff policy. Reason we bring that up, again, back to the earlier question, who should investors be watching out for in terms of just clues where policy or policy pivots go next here?
Yeah, so as you mentioned, Peter Navarro was really the top Trump aide who put together this whole policy during the campaign and was a front person for it in recent weeks. It's kind of early to say whether we've hit peak Navarro, but it does seem that Treasury Secretary Scott Bessent has really moved to the fore here, along with Commerce Secretary Howard Lutnick. Bessent had been talking about focusing on a tax deal with Congress. He seems to be setting that aside, at least partly, to focus on negotiating these trade deals. So we know he's already met, in terms of countries in our region, with the Vietnamese Deputy Prime Minister, and he has put Japan at the top of his list for reaching some kind of a deal. So I think there's going to be a big focus on how quickly he can come out of the gates with some kind of a deal with some of these countries that are, according to the administration, their top priorities.
Bill, thank you so much. Bill Ferry's there, our senior editor. Right, some breaking news, a couple of things here, all concerning China. Let me get started here. President Xi Jinping, according to the Ministry of Foreign Affairs, will be visiting Vietnam April 14 to 15, so that's Tuesday next week. Tuesday, yes, 14 and 15. We're also looking at from the 15th to the 18th, the president then moves on to Malaysia and Cambodia, right? Just on the central premise of reaching out, given the tariff conversation taking place. Now, on that very note here, Bill, you're looking at some things as well as far as monetary policy is concerned here.
Yeah, that's right.
Yeah.
So we've just had some other headlines that are crossing here saying that there's been a meeting between different central bank governors or discussing really the impact of US tariffs. So this is a meeting between China, between Japan, and also between South Korea. So the neighbours in the region, of course. They're looking at, China says at least, that they're looking at implementing moderately loose monetary policy, which again has sort of been the expectation. We could see some easing being quite imminent, and that's been signalled as well in state media.
Don't be surprised, and again, like this is pure speculation, but don't be surprised we get that sooner before later. And really one of the windows they tend to use there is late Friday or into the weekend as an opportunity to introduce more easing. There's a daily operation, plus, of course, we're moving into April 20, which is just 8-9 days away in terms of the setting of loan prime rates. And that's another window, of course, to consider. Anyway, a lot of breaking news coming through here.
Yeah, that's right. And just to note as well, that meeting discussed the impact of US tariffs on the global economy, which is the subject as well of today's big take. You might expect a lot of big takes that are focused on this over the coming weeks. But this one taking a look in particular at how the tariff turmoil is leaving Wall Street flying blind heading into the earnings season. So subscribers go to find that on the terminal, on our website. That's Bloomberg.com, of course. We'll have plenty more ahead. This is Bloomberg.
So we're wrapping up this week. It's really been, when they say one of those weeks, historical week in some sense. So, you know, when they say follow the trend this week has been nothing but hard to follow. So the 10-day actual vol on the S&P 500 has now surpassed the levels we saw during the European debt crisis in 2011. So the only comparable peaks, really, over the last, call it 100 years, going back to World War II, global pandemic, global financial crisis, and Black Monday of 1987. Yep, those are the sort of moves we're seeing this week so far. Unprecedented, really, in some ways.
Unprecedented. And then we're just speaking with our next guest, Alain Bokobza, head of Global Asset Allocation at SocGen, also joining us this morning. You're talking about how that level of volatility is also leading to some unprecedented conversations as well.
Indeed, it's like we are living and pushing a reset button on the organization of global geopolitics, global economies, global trade flows. And so there is a destabilization on the way investment managers look at the forward-looking world. And if I had to sum up what is being discussed, is have we started the great rotation out of US assets? That is the major theme. In the end, we are all debating that if you look at asset allocation from the biggest asset managers, the ones who are global, can be anywhere in any asset class, they were extremely weighted on US dollar, on US equities, on US technology, if not the Magnificent Seven, on US credit, on everything in USD. And so that excess concentration has led to very deep damages in portfolios because we are watching the volatility. Volatility is also asset prices falling hard. And in history of volatility, something you could mention, that normally in a peak of US equity volatility, the US dollar is a safe haven. I haven't seen this safe haven working this time. The US dollar is falling. US treasuries are rising. So you lose money on bonds, you lose money on the currency, and you lose money on the equity market. That's a wake-up call for all global managers that they need to re-diversify their portfolio in what we call the great rotation.
Where to then?
So from the investment processes, so the methodology to be disciplined, not panicking. It's when you have volatility, it's like you have a gameplay which is wonderful. You use volatility and market prices which become dislocated to make your shopping. And when you go from quality growth, exceptionalism, Max 7, into value, everywhere it is value. But when you go into value, you need to be careful not to go into what we call the falling knife. You know, it's value because there is a bad story in it. So, and that's what we call the falling knife. So I'm a pianist, so sometimes I tend to take value quite late in the cycle. And so you had for so many years underperformance of everything but US equities. Every currency against the US dollar was falling over time. So when you do value, you need game changers. Something which the story, which was not good, turns into hopes, and then you climb the wall of worry, which makes a bull market. So to make a long story short, in China, we all know that they are prepared to put on the table a very heavy stimulus, which would be major in fiscal and somewhat in monetary. Europe makes nobody very tax, ongoing, reshuffling on the way Europe does economic policy, starting with Germany putting 1,000 billion euro on the table. And Japan will bring normalization of monetary policy. Wage growth is 4%, which means domestic economy is running up. And the yen will continue to soar. So I'm looking at reinvesting in China, mainland China, unhedged.
Unhedged?
If you say that over time, and this has started, the great rotation, that the US dollar will unilaterally fall. And you can accept the revaluation if you were Japanese, if you were Chinese, if you were Germans, if you were British. You can accept a substantial revaluation of your currency if all the currencies outside the US run up together. Some will go more than others. But you don't lose in relative competitiveness if all the currencies go up. So this is the reading we have. It's that it is a US problem. It is a US risk premium problem. And then we need to find the triggers. If you say the yen is going up substantially, it has started. We have 20% of the currency allocation in yen. We had it from mid-March. As a portfolio protection, that was not bad, as a call. And still a lot to run. You go, if you do equities, more domestic than international companies. And then you have a long short, which can be extremely powerful. If you go in China, the stimulus will go to the consumption. This is what is needed to go back into some confidence. So you go into Chinese tech, which is definitely competing, if not beating the US tech on AI. And we have built a concept, a basket of, remember the Magnificent Seven? We have built the Titan Seven, which are the most beautiful blue chips in China to beat the Magnificent Seven on the stock market.
It's interesting because the value traps, to your point, have underlying not too obvious stories. They're value traps. And for the longest time, Europe was a value trap. For the last 3-4 years, China was a value trap. Japan, for call it a decade and a half, is a value trap. You're saying those three markets are no longer value trap. How convinced should we be of those alternatives to the U.S.?
Very high. Very high conviction. And if I may say so, the way the U.S. administration is going beyond one man, and it's the whole administration, the casting in every position has the same target, which seems to go like a boomerang against the U.S. themselves. Yes, some U.S. economists are talking about possibility of a soon-to-come U.S. recession. I don't think this is America first, no? There are risks to the U.S. cyclical activity coming from exceptionalism. So many years of outstanding growth. So it is more not the conviction on the game changers that this administration in the US triggers for the rest of the world. It is a trigger to accelerate the reform, to accelerate the push. But it is how you gear, how do you play China? And if you believe that reflation is coming, that billions of dollars are going to be put on the table for the consumer reflation, then it is the start of a new cycle for the Chinese domestic index. And when you look at the Xi Jinping re-embracing the private sector, for some years he was not focusing on them. So the message we have received that in the reflation plan, he wants the private sector, he wants the technology sector to be part of this. That is some of the gathering we have seen in the last weeks. The message given is outstanding on the trigger that they are ready and they will put the consumer plan on the table very soon. So we wish to be ahead of the announcement, that is strategy, to be ahead of the announcement and to be working on the triggers to come. That is for China. So we are quite optimistic. We are building position, using the current volatility to build position for the medium term. The Japan equity market can continue to be disturbed, not only by the rise of the yen, because the content of Japanese equities are full of exporters, so that's disturbed. They have a lot of automobile. They will reach a good deal on the trade floor. They are very strong on diplomatic issues. They will get a very good deal. So you have some relief against the trade war given to Japan first, and we go more domestic. So it's more a long short. But the equity index is disturbed. by the rise in the yen and the volatility of the yen itself, which translates into the volatility of the equity market. So we are not that aggressive top-down on the equity index, but it is a long short, which is outstanding for tens of % of expected return. And in Europe, you have the fiscal rearm, as we call it in Europe, so that is the Europe investing in their own defense, and that is manufacturing. This is growth. So what we read, if I wanted you to maintain, to have a view of how we read Europe, it's like a J curve on the growth outlook. And in the very short term, you have to take the hit from the tariff and the disturbances on the trade flow. Europe is a very open economy. So in the very short term, the European Central Bank is going to cut interest rate in the very short term, possibly more than we expect. But then you have kick in the reflation plan, infrastructure plan. It is the defense plan. This is manufacturing, this is jobs, and this is growth. So we are working on a J curve for Europe. And as you said, for so many years we have not been listening. European policymakers interested in doing growth.
What happens, though, the relationship, because you're talking about a very big decoupling, the rise of China, the decline of the US as a superpower. What does Europe do in this? We know that there's another delegation going to China in the midpoint of this year. Does that relationship continue to strengthen then?
In the end, in the phrasing, you have two ideas in one. One, in the global trade war, Europe is extremely strong against the US. They did not retaliate big because they know they are very strong. The US has a big trade deficit against Europe on goods. But Europe has the similar surplus on services. So the balance of exchange between Europe and the US is flat. So the communication of the US administration is exclusively on trades and goods. They want to remanufacture at home. That is their target. But they are very narrow-minded. And Europe has stated, against yesterday from von der Leyen, the trade deals are made at the European level, the EU27. And she stated extremely clearly what we all know, that the US are extremely vulnerable on the negotiation with Europe because they have gigantic surpluses on services. It is digital servicing, streaming, digital, airlines, financials. And so that's easy to put tariff on everything, taxes on everything, and they will be hurt very much. So in the negotiation phase, they have been officially, on what we read on the news flow, relatively shy because they know that in the back door, when they discuss with the administration, they are extremely strong in their power to retaliate. So in the end, to give you the bigger picture we read, Europe has taken 20% tariff, 25% for a few sectors like automobile or steel. In the end game, our reading is about 10% max. So there will be a relief rally on this. And then you have the second part of your question, which is how do you reset the button on global geopolitics, that it is a possibility, for now it's a question mark with a positive bias in the answer, that it will also reset the discussions between China and Europe as a bloc. And yesterday have reopened the quantity of tariff Europe makes against Chinese electric vehicles, which may be going down against something. This something is going to be disclosed. They are discussing deep to reopen the relationship in a more long term as partners to decouple from the US. The heart of what we are all discussing globally is decoupling with the US.
Alain, we covered everything, and really the major pivot points that we need to be paying attention to. It was fantastic speaking with you. Let's do this again. Let us know, of course, next time you're here in the region. Alain Bokobza there, head of global asset allocation at Societe. Right, markets slightly on offer, coming off lows of the day. Plenty more ahead. A market roundup is a few minutes away. Don't go away. This is Bloomberg.
You're watching the China Show here, taking a look at some of the stocks that are moving this morning. One of these are the Chinese movie names, of course. This is in reaction to what's come out from Beijing overnight, that essentially they're looking at limiting Hollywood films. That's as the trade war starts to impact services as well. The question, of course, is it's not an outright ban, it's a limitation. And we've had some commentary, for instance, from IMAX, which operates around 800 cinemas across the mainland. And they're saying it could be the smaller, less popular titles that are restricted instead of the big blockbusters that are obviously needed to try and lift retail traffic rather in malls. Also taking a look at some of the Korean shipbuilders. These are rallying this morning on President Trump's comments that it could be looking the US to order more ships from other countries. Korea is one of the largest shipbuilding nations in the world. And also just taking a look at some of the tech movers this morning, Baba, JD, Miniso, just some of the names in mainland China that we're taking a look at this morning as well. More ahead, this is Bloomberg. Welcome back to the China Show. Going to a very interesting listing time. It's a pretty brave company that decides to IPO right now.
Time for drinks. It's Friday.
I guess so, yeah. But this is a non-alcoholic variety. This is the Chinese TJ.
Better for you.
Thank you, Dave. Chagee launching a US IPO, and that's despite, of course, this market volatility that's been well and truly whipped up by President Trump's tariff policies. Let's get more now with our Asia-Pacific deals reporter who leads the team as well, but Manuel Baigorri joining us this morning. So, Manuel, talk us through it. Why now exactly?
Yeah, that's a great question, Annabelle. I mean, everybody with this volatility was thinking, well, deal making is going to be brought to a halt. And somewhat that's top of the agenda now, trying to figure out the impact on the tariffs and the volatility. But what's true is that deals continue, and we've seen a number of M&A and IPO deals kind of like being announced. We saw also Prada Versace out of Europe overnight. And Chagee, as you mentioned, bubble tea is back in a way. I mean, you saw last year when there was like all the back and forth about the bubble tea companies, but some of them, those of higher quality, so to speak, and a little bit more mature, are definitely in that late stage. I think for deal making, the way we are seeing it is those deals that were at that very advanced stage, they are proceeding. It's perhaps those deals that were a little bit more preliminary, about to launch, that are having second thoughts, right? Whether or not is the right time to proceed with the deal. But those that were in a very advanced stage, those top high-quality companies, they are proceeding for the time being. Now, whether or not the demand will be there when they actually execute the deal, that remains to be seen.
We've been waiting. I mean, speaking of deals here, the CATL, they've now gotten approval.
Yes.
To list. I mean, we've been waiting for this. It's possibly the world's biggest this year. What do we know? And on the timing too, when might they actually pull that trigger?
Yeah, I mean, Dave, that's one that everybody's watching closely. I think it's a bit of a bellwether for other ECM deals, particularly here in Hong Kong. There is a number of those second listings in the pipeline, right? So I think CATL is one that people are watching closely. What we understand is that the deal is proceeding, working is being done, and the idea is to continue with the deal. Now, whether or not it takes a little bit longer, I think they first originally targeted April. Things may slip into May. I mean, that wouldn't make much of a difference at the end of the day, as long as the deal gets done and the performance is good. Our understanding from what we hear with sources is that there is a good chance that the deal will get done. Now, obviously, let's see how the next few days and weeks, perform.
Well, it's a low bar, really, compared to what we're seeing this week in terms of certainty. So we're hoping for the best, expecting the best. Manuel, fantastic. Thank you so much, Manuel Baigorri, there, our Asia-Pacific deals reporter. Really, from equity deals, let's turn now to what's been happening in terms of issuance, bond issuances this week, given just this unorthodox week that we've had. Move index on your screens, a measure, of course, of bond market volatility. As you can see, things spiked up substantially. Levels last seen 2 years ago, and really remain quite elevated, given, of course, the level of uncertainty out there, and markets remain fairly attuned to extreme headline risk. Let's get a sense now of how the markets coped with this and what the outlook looks like ahead in terms of pipeline and volumes. Rishi Jalan is here, APAC, Debt Syndicate head there at Citi joins us here. Nice to see you, man.
Thank you. Thanks, David and Annabelle, and thanks for having me back over here.
It's been a weird week.
It has been a very, very weird week, and probably one of the most volatile ones that we've seen in recent times. I think maybe just drawing back from scratch, right, where we are this year, we're up about 65% in terms of volumes in Asia ex-Japan G3 debt. That's 75 billion of issuances from the same period last year. If you look at the broader APAC region, so that's including Japan and Australia, we're just shy of 150 billion, up 46%. So despite what's happened this week, I think the underlying fundamentals of the credit markets have been pretty intact as we've gotten into 2025. At Citi, we're keeping our estimates for the end of the year still put, so 20-25% rise in terms of volume. So that would take Asia ex-Japan volumes up to about 225 to 230 billion.
Okay, so you're still expecting strength essentially in issuance over the coming few months. You haven't seen sort of any changes off exactly what happened this week?
Yeah, we certainly have. And of course, we've seen a blowout in credit spreads. So Asia, iTraxx, IG, CDS, which is something which we track very closely on the bond market, blew out about 40 basis points. And that's come back in slightly, but it's still elevated from where things were previously. But we have had a few new issues in the broader sort of global capital markets. So JTI, Japan Tobacco, just printed $2.5 billion in dollars and 550 million in euros overnight. We were on that deal. We had to pay a new issue concession, but the deal was very well sort of subscribed. All the real money investors were there. Earlier this week, we saw a trade from Paychex from the US for the acquisition, financing requirements, and they raised $4 billion plus in bond markets. So, you know, for the right price, there is deals to get done. For the right names, the market is still open. But as we sit right now, we were supposed to have somewhere between 6 to 7 deals this week, which got pushed out. But I think as we get into next week, depending on how the market backdrop is, the willingness of issuers to pay up a new issue concession, I think those deals get done.
What's a trigger, you think, that might reopen the gates here next week? What are you watching out for in markets?
Yeah, so number one is a stable market backdrop or some form of stability, right? So whether it's U.S. Treasury yields remaining sort of within sort of ranges, whether it's credit spreads not materially blowing out or coming in, I think that would give us a good enough background to sort of go ahead. We've had the global new issue data points that have come out by way of these couple of trades. So we have a sense on the premium that issuers and investors need to pay or are asking for, yeah.
But how do you price? I mean, it's just so difficult to know. And also because we're not even have any sort of clarity on negotiations and how they're going, if we're going to see certain countries or sectors that are being spared, what's next that's going to be hit. Pharmaceuticals, for instance, was one that was being touted earlier this week by Trump. I mean, just give us your insights on that one.
Yeah, sure. And that's a good point you raise, Annabelle, because the market is probably open for known issuers. So issuers who've had access to the markets previously, who have come to the market, are well known with the investor base, and they're comfortable with the credit, right? If you were to bring out a new inaugural issuer, I think they would struggle to get something done in this market. But for no names, household blue chip names, I think the market is going to be open.
The expectation is, let's try and strip out, and I know it's difficult to do that, the tariff story, because what you're left is, and this is going to sound fairly pessimistic, what you're left with is really slowing growth and disinflation. And the reason I bring that up is, what are your expectations and what are clients' expectations in borrowing costs moving forward?
Yes, so there's definitely going to be a rise in borrowing costs. If I just take a look at the credit spread movement and the treasury yield movement, we're probably somewhere between 50 to 75 basis points wider or higher in terms of borrowing costs than where we were pre-tariff. So there's no question about that. If the market corrects itself, if we were to see a better sort of tariff negotiations between the U.S. and other countries, market settles down, you know, the recessionary risks play out, you see treasury yields move lower, maybe some of that, you know, sort of negates, but I think all in all the treasury costs as well as the credit spreads are going to remain elevated, which leads to higher borrowing costs.
I mean, if borrowing costs are going to increase, obviously as a company you're going to want to issue now. I just still don't get the demand side, though. Are you going to see any sort of mismatch developing?
Look, I think what our investors are telling us, and we've done a few rounds of calls this week with our clients, they're seeing very little outflows from their funds. So it's primarily driven by retail or high net worth individuals. The institutions aren't driving money out of these funds as yet, so they are liquid. Cash balances at investors within Asia are somewhere between 7 to 10%, which is higher if you go back to periods such as Brexit, such as COVID, right, or even the Ukraine-Russia situation which took place, right? You have investors with very healthy cash balances, so there is money that needs to be deployed. There are very good opportunities in the secondary market, but there's limited sort of, as we call it, bottom fishing. Investors aren't just going to go in and buy something because it's looking cheap, because that price could be lower the next day. But for a new issue, if you have a solid name coming out, you're paying that new issue concession, and investors shouldn't worry about coming into that bond.
That's mostly in a dollar rate story. What about local currency debt, and whether or not there's a pivot, in fact, now to local currency that's slightly perhaps more, you don't need to think about hedging, perhaps, where there's a bit more predictability in local currency rates?
Absolutely, and I think that's a very thematic topic for Asia specifically, because you look at Australian dollars, you look at Hong Kong dollars, CNH, rupees. We've seen double-digit growths in the local currency markets. The investor base has gotten more comfortable buying, lower-rated credits out there as well. So you've now seen a shift, right, from what was primarily a G3 bond market into Asian local currencies. So if you play that out, we have 250 billion of redemptions for 2025. And even with my expectations of 225 billion of new issue, you're going to still be net negative in terms of supply, right? So that money has got to be raised from other forms, whether it's the bank market, whether it's the local currency bond market. And I think the divergence in central bank policies, if Asian economies were to lower rates quicker than the US, then I think you could see more issuers looking to tap into the local currency markets in Asia.
What else have we not talked about? What's macro agnostic that you think will persist, that issuers should be keeping in mind right now as they look to tap?
Yeah, so one avenue that we're seeing growth in is private credit, right? So I think that's an avenue where the investors tend to be a little bit more fundamental in their approach, so a little less or a little bit more insulated towards the treasury moves as we're seeing right now, right? So yes, maybe pricing's moved up a little bit, but they're still willing to buy a credit if it makes sense, if they are able to get a different part of the capital structure, if they're able to get specific covenants which wouldn't otherwise be available by the public bond market. So there are these bespoke deals that are taking place in our market through private credit funds.
Rishi, really great to have you in the studio
Fantastic.
this morning. That was Rishi Jalan, their head of APAC Debt Syndicate at Citi, and we're going to have plenty more ahead. This is Bloomberg. Right, back to some headlines now that came at the top of this hour. Essentially, President Xi's travel schedule over the coming week, but the Chinese Foreign Ministry has confirmed that she's going to be visiting Vietnam, Malaysia and Cambodia in the coming days. So let's get more now with our China correspondent, Min Min Lo. And, I mean, yeah, what do we know about the trip? And also, I mean, it's definitely a significant one, given we've got this risk now that what Trump's done is going to, of course, really put that focus on how China can shift and build its relationships with other countries.
Yeah, I think it's interesting to note that this is President Xi's first overseas trip this year, and he had chosen to go to the Southeast Asian nations because I think it was SCMP that reported that there was a little bit of a tussle with the EU leaders wanting President Xi to visit Brussels, but President Xi was not open to that, and that's why the European leaders are looking to come to Beijing in July. So clearly China is placing its Southeast Asian neighbors first, not surprising given that ASEAN is the biggest trading partner of China, and of course a lot of that China Plus One strategy has seen many Chinese companies shifting production to countries like Vietnam, Malaysia, Indonesia, and these countries are being slapped with tariffs as well. So President Xi, I believe, will want to go to these countries to scope out what they will be offering to the U.S. in order to get lower tariffs from the U.S. At the same time, of course, pitching China as this counter party to the U.S. that is very stable, very reliable as a partner, taking that opening that Trump has handed over to him, and to continue to reach out to these countries to deepen their trade ties with China. It's coming as China is also hosting the Spanish Prime Minister Sanchez as well. And of course, I think there has been media reports that Emmanuel Macron from France is possibly looking at a trip to China as well in the second half of this year.
I mean, speaking of discussions taking place, I woke up this morning, one of the first stories I read was Argentina and the PBOC resuming that swap program ahead of tariffs. And, there are discussions taking place, I would imagine, among central banks and among policymakers. China, Japan, Korea, I would imagine, are discussing these. So what do we know about that in terms of being able to shelter their own financial systems from what's going on?
Yeah, so this took place on the sidelines of the ASEAN meeting in Kuala Lumpur, and the central bank officials of Korea, Japan, China had met to exchange views. Not a lot of details as to what was discussed or whether they are planning to coordinate their policies, but we know that last month the trade chiefs of China, Japan, Korea had met to exchange views and talk about possibly speeding up this free trade agreement discussion that has been put on hold for many years. And suddenly it does look like there is increased willingness to engage with each other, although we have Seoul and Japan actually coming out to defend against these rumors that are floating around because of information put out by a Chinese social media account linked to the state media, saying that the three countries are going to have a coordinated response to U.S. tariffs. And I think Seoul says that that is highly exaggerated. But certainly the central banks are talking to each other to discuss how to deal with these tariffs.
Min, thank you so much. Min Lo, our China correspondent. Belle, in fact, just on that last idea that Min just mentioned, I mean, we were speaking earlier with the Philippine Central Bank governor, and he in fact acknowledged that he is in touch with his peers across the region.
Yeah, Eli Remolona, and he was saying that essentially, even if they're a little bit more insulated than other economies in the region, of course what happens impacts them. There's a slowdown in global trade generally, and also talking about the influence of China's response and how China retaliates against the US. What impact does that have on Southeast Asian countries too? Yeah,
who blinks first? Will China blink first, I think, is the question there. I mean, he stopped short of naming who he was talking to, but suffice to say, we have a good idea that because regional central banks, among others, same time zone, I think is how the governor described it as well. Right, now just on that note that we were talking about there with Belle, who blinks first, right? As Donald Trump certainly ramps up his trade war against Beijing, you have Karishma Vaswani, our Bloomberg Opinion columnist, believes that, to that point, China won't back down first because President Xi Jinping can withstand more economic and more political pain than his U.S. counterpart. She joins us right now to talk us through the thesis there. Karishma, you don't think China blinks first. Why not?
Well, David, I think the main reason is because Xi Jinping is in a much more politically powerful position than Donald Trump. He is effectively the most powerful politician that China has seen since Chairman Mao. He doesn't have to face midterm elections the way Donald Trump does. On the economic side, yes, of course, the Chinese economy is in a difficult position, and there is no doubt whatsoever that these tariffs will have a huge economic impact on China. But they will also make goods in the United States more expensive for American consumers. That's going to start to bite no matter what Donald Trump and the administration says. And there are already concerns emerging from the United States about the impact, the long-term impact of either an economic slowdown or a recession. Those kinds of things will start to feed into the narrative in the U.S. in a way that they won't necessarily be fed in China, partly because of the degree of control that the Communist Party has over the media and over public policy. But also, this has been a huge opportunity for the Chinese to consistently bang on with that narrative that I've talked to you about before, David, on the program, and certainly written about in my columns, which is China is being put down by the United States. And this is another example, they believe, and they are saying to their people, of not withstanding the fight from the U.S., not taking this lying down. And I think that's why Beijing will consistently show a very bold face to the U.S., the way we've seen in the last few days.
But China's not the only one taking this strongman approach, because the US as well, at least Trump for now, is sticking to his guns. So is there any room for a détente?
No, you're absolutely right, Annabelle. And I think it's really interesting that we heard from Donald Trump, this idea, while also putting more tariffs on China, that, hey, look, he said, I'm open to a phone call. I'm expecting a phone call, words to that effect. I think that was a sort of olive branch to the Chinese. Whether or not they take it, that's the big question. There has been some reporting about the fact that what the Chinese are waiting for is some kind of backdoor diplomatic channel to open up between the two sides. And that, in my view, would be very wise. But Xi Jinping and his advisors aren't going to agree to any sort of meeting which puts China on the back foot. And why would they? They've seen examples of what happens when politicians like Zelensky, for example, go to the White House and are effectively embarrassed on the global stage. That is something that Xi Jinping and the Chinese Communist Party will not accept. They will not want to have a meeting where Beijing is also not in charge.
And, this is like, I was having a conversation with a colleague recently. It's like watching one's parents divorce, and they're, in fact, moving even further away from each other. And, the likelihood of reconciliation seems to be just getting even further. And I just need to ask what the impact of this divorce will be on the rest of us.
Yeah, David, that's such an excellent question, and it's certainly been on my mind as well. I mean, cast your mind frame back to 2018 when the first US-China trade war sort of really kicked off, right? And at that time, there was a sense for the rest of us. We got our first sense of what this divorce might be like. But then, COVID happened. There was a sort of a stop to all of that. The Biden administration came in still tough on China, but in a much more reasonable fashion. And to take that divorce analogy further, it was a negotiated settlement that the rest of us could, as the metaphorical or figurative children of this union, could live with. This time round, all bets are off. And I think what we're going to see, as I've written about before, is China making those inroads with other parts of the world, particularly in the Indo-Pacific. As our China correspondent, Min Lo, was just talking about to you guys, that visit to Southeast Asia, really essential, really important, and the key, I think, factor of what we're going to continue to see from the Chinese going forward, trying to make that messaging really clear that it's China that's the global grown-up on the global stage. It's the one trying to make trade deals. It's the one trying to, stand up for the rules-based order, notwithstanding with the caveat, of course, that China likes to use those rules in order to improve its own advantage in the global arena. So I think what we're going to see is a very ugly split, and the rest of us are going to be collateral damage, unfortunately.
All right, doesn't sound too upbeat, really, for a Friday, at least. At least that's our opinion columnist, Kurisha Vaswamy.
I'm so sorry.
There.
I wish I had better news for you.
Well, the night is young.
Let's try again Monday. We'll see. We'll see if it can improve by then. But we'll have plenty more ahead. This is Bloomberg.
Right, welcome back. So just before we wrap up shows here, and as we move into the thick of Friday, there's really been just one consistent trade. Long gold, sell almost everything else. And this is really a look at the gold futures curve. So you do have a 3,200 handle now on the, sort of the near end contract. You look further out, right? So December 2026, 3,400. I'm looking further out into, get this, 2028, and you have a 3,600 handle on the contract there. Suffice to say, gold is bid.
Absolutely, and as a result of that, you're actually seeing the gold-linked stocks as well rallying pretty strongly this morning. You can see there China Gold International, for instance, up more than 10%. It's not just a story of bullishness here. You're actually seeing some bullishness in the EV names this morning as well. Yeah, on the back of this discussion, or report of a discussion between Chinese and BYD on the back of this EU tariff discussion report. So on that silver lining and that bright spot, happy Friday. We'll see you all on Monday.